The U.S. economy is standing at a dangerous crossroads in July 2025. And if you're not paying attention, you might be walking straight into a financial storm. Inflation is no longer the biggest threat. What's looming now is something deeper, more systemic, and far more personal. This isn't just about numbers and graphs. It's about your savings, your job, your home, and your future. As we move deeper into the second half of 2025, warning signs are flashing red across the board. Consumer debt is skyrocketing. Student loan defaults have spiked to levels we haven't seen since 2008. And even the wealthiest Americans are beginning to shift their portfolios toward safety. Why? Because the foundations of the U.S. economy are shaking, and the cracks are no longer invisible. Let's start with unemployment. The official rate may still hover around 4%, but the real story is hidden in the underemployment numbers and the mass layoffs in tech, finance, and logistics. Behind closed doors, companies are cutting costs aggressively. Over 110,000 layoffs have already hit white-collar jobs in just the first half of the year. Gig workers are barely scraping by. And small businesses, many are shuddering under the weight of high borrowing costs and collapsing consumer demand. Speaking of borrowing costs, the Federal Reserve is in a no-win situation. After keeping interest rates elevated for nearly 2 years, inflation has cooled, but at a tremendous cost. Real estate markets are freezing. Mortgage applications are at their lowest point in 28 years. And while the Fed has hinted at potential cuts, they're moving cautiously. Why? Because they're terrified of reigniting inflation in an already fragile global environment. But here's what most people aren't being told. America's debt burden is reaching a breaking point. As of July 2025, the U.S. national debt has crossed $37 trillion. Interest payments alone are set to surpass defense spending this year. The Treasury is issuing more debt to cover existing obligations. A classic red flag. If interest rates don't come down soon, the government faces a dangerous spiral of debt refinancing that could devalue the dollar, erode purchasing power, and unsettle global markets. Now let's talk about the consumer, you and me. Credit card delinquency rates have surged past pre-pandemic highs. Auto loan defaults are climbing. And for the average American, every trip to the grocery store feels like robbery. Prices may not be climbing at 9% anymore, but they've stayed painfully high. A phenomenon economists now call sticky inflation. Real wages haven't kept up, and it's getting harder to stretch every dollar. Then there's the housing market, where the crisis is shifting from affordability to stagnation. With mortgage rates still around 7%, home sales have plunged. Homeowners are locked in with ultra-low rates and refuse to sell. Buyers can't afford new mortgages. Builders are cutting back on projects. And in major cities, vacancy rates are ticking up as renters seek cheaper alternatives or move in with family. This gridlock is unprecedented, and it's freezing a key pillar of American wealth. Now here's where it gets even more dangerous. Confidence is evaporating. Investor confidence, consumer confidence, even international confidence in the U.S. economy. The BRICS nations are pushing harder than ever for and recent oil contracts between China, Russia, and the Middle East have been settled in local currencies or even gold. Foreign demand for U.S. treasuries has declined for 3 straight quarters. This isn't just symbolic, it's strategic, and it should worry anyone holding dollar-based assets. So what does all of this mean for your money? If you're investing in the markets right now, July is not the month to be asleep at the wheel. Volatility is the new normal. The S&P 500 had its worst start to a July in nearly a decade. Treasury yields are swinging wildly. Gold and Bitcoin have both surged, a clear signal of investor hedging. And cash. Yes, cash is back in style, as investors wait for clarity. But here's the kicker. Most people will miss the signs until it's too late. They'll keep spending, keep borrowing, and keep assuming everything will go back to normal. But July 2025 might be remembered as the moment when normal broke down for good. We're watching a realignment in geopolitics, in monetary policy, in global trade, and in the basic rules that once defined how money works. So what should you be doing? First, reassess your portfolio. Diversification isn't optional anymore. It's survival. You need to hedge against inflation, interest rate swings, and currency instability. That means looking at hard assets, dividend stocks, precious metals, and even select international exposure. Don't over-leverage. Keep dry powder. Second, build liquidity. If a recession hits in Q4, and that's looking increasingly likely, the people with cash will be the ones who thrive. This isn't about panic, it's about preparation. Third, stay informed. The media won't tell you what's really happening until it's already done. That's why independent channels like this one, MacroMotive, exist, to give you unfiltered analysis, accurate forecasting, and actionable insight. And finally, don't wait to react. Anticipate. Because once the panic sets in, opportunities vanish. July 2025 is not just another month, it's a warning. And if you're listening now, you're already ahead of 90% of the population. Thanks for watching MacroMotive, the channel that helps you stay smart, stay curious, and stay ahead of the financial curve. If this video helped open your eyes to what's happening, please hit that like button, subscribe for more deep dive financial analysis, and share this with someone who needs to hear the truth. The future belongs to those who prepare, and preparation starts right here.